Can you see my screen?
Yes.
Okay, great. All right, so we are getting started with chapter 4, which is the balance sheet and statement of cash flows. We have done income statement last week. You also have done some questions in class. You have done homework questions. And so we are ready to begin the next topic, which is the balance sheet and statement of cash flows. So I'm going to go ahead and put it in the present mode. The balance sheet is basically a financial statement that presents a picture of what the business's assets are, right? So, what they possess, and liabilities. So, what are their obligations, and also the equity, right? So, balance sheet is a comprehensive picture of all of these three components: the assets, the liabilities, and the equity. While the statement of cash flows that uses information from the income statement, if you remember, we did that in the income statement, the residual earnings, they are reconciled into the balance sheet. So the statement of cash flows uses income from the information from the income statement, what your earnings are, and the balance sheet. So basically, it adjusts both of them to reveal where a business obtains the cash and what does it do with that cash. Okay. So there are some basic things about balance sheet. The first thing about the very basic thing about balance sheet is in the name, which means that both sides should balance. Okay. So if you have some assets and you also have the liabilities and equity of the business, um, you need to it is on the left, so assets are on the left side and the liabilities and the equity are on the right side, and both sides, when I say both sides, I mean the left side and the right side should balance. The balance sheet presents a business's position at a given point in time. So your balance sheet in January of 2023 might look different from December of 2023. And that is the difference between income statement and the balance sheet. The balance sheet is for a specified date or for a specific time, whereas the income statement is for a given period of time. The data can even become invalid by the next day when both dates are in the same accounting period. So we really have to make sure that we understand the difference between a balance sheet and an income statement. It is really about the specificity of the date. Okay, so this is a basic structure of the balance sheet. The right side reports sources of capital that are used to acquire the assets on the left side. And when we balance it, balance it, we want to say that the left side is equal to the right side.
Dr. Yu, I'm sorry to
Yeah,
interrupt, but the slide's stuck on the
yeah,
title
we can only
page.
see the title page.
Oh, really?
Yeah.
No.
Oh, okay. I'm sorry about that. How about this? Is it working?
No, it's not.
It says it's sharing the window, which means that it should just show whatever I'm seeing.
Yeah, what
Hmm.
we're seeing is the it's not in presenter view or anything, so it's just the full screen of the PowerPoint. And we can see slides 1 through 4 on the left side, very small, and then we can see slide 1 big.
Oh, but I did put it in the present mode. And okay, let me stop sharing and then try sharing it again. Thank you for letting me know. So you're seeing this, right?
It's just you right now.
Oh, just me. Okay. Okay, let me do presenting of the entire screen. Now you can see the slides on the left and the one on the right, right? You can see that?
Yes.
Okay.
We can see slide 4 right now.
And I'm clicking on the slideshow. You can see that too?
Yes, we can see your mouse.
Okay. Let's see if this works.
Now it's in
Is it
presenter view.
now you can see it properly?
Yes.
Okay, great. All right. So this is where we were. The balance sheet is organized with the left side or upper section and the right side or the lower section. And the right side reports sources of capital that is used to acquire the assets on the left side. So when we are trying to balance it, we mean that the left side should be equal to the right side. And equity is the residual claim against total assets of a business. And this is the equity. So I'll try to explain it in a very simple way what equity means. So let's say you bought a house for $100,000, right? And you paid a down payment of $50,000, and you bought a loan. I mean, you got a loan for $50,000 to pay for the house, to pay mortgage for the house. Now, after 5 years, the house is valued at $200,000. Okay, but you still have a $50,000 loan to pay. So that is your liability, right? You have $200,000 as the market value of the house, but you still have $50,000 loan on the house. So your equity will be $200,000 minus the $50,000, and that leaves you at $150,000 as equity. Make sense?
I think so.
Yeah. So when you minus your liability or the loan from the from your asset, which is 200,000. If you sell the house today, you will make $200,000. So that is actually your asset. But remember that you have a loan on it. You still have to pay that loan. So you minus that amount, and then the remaining that you get is your equity. That is $150,000. So this is the basic accounting equation. Assets equals liabilities plus equity. And it is also expressed as, or in fact, often expressed as, equity equals assets minus liabilities. So this shows the fact that equity amount is the residual. When you remove liabilities from your assets, what you're left with is equity. Making sense?
Yes.
Okay. Any questions so far?
No questions for me.
What are the main components of balance sheet? What are some main components of the balance sheet?
Is it like the assets, the liability, and the equity?
Yeah. So this is our accounting equation, and we just saw that assets, liabilities, and equity are the basic structure of a balance sheet. And what is the key thing about a balance sheet? What is the main central point about a balance sheet?
The left has to
To
equal
balance
right.
the,
Say that, sorry.
The left has to equal the right.
Yes, it has to balance, and it is in the name itself. So the left should be equal, should equal the right side. Okay. So here's an accounting equation. You can think of a balance sheet in terms of home. Oh, actually, this is the example that I was telling you earlier, home ownership. So let's say your home is valued at $300,000 today. Okay. So your total assets are $300,000. But your mortgage, the loan that you got was at $200,000. So your equity is 300,000 minus 200,000, which is 100,000. So your total liabilities and equity together is 300,000. So you have to pay a loan of 200,000 and you have an equity of 100,000. But these are market values. So what happens if the value of the house falls to 250,000? So let's say this value is 250,000, not 300,000. How much will your equity be? This, are you seeing the slide?
Yes, we can see it.
Okay, so 250,000 home value, that's your asset. And your mortgage is 200,000 still, right? You still have a loan of 200,000. How
And
much?
your equity would be 50,000?
Correct. It will be 50,000. What if the value of the house falls to 150,000? 150,000 here.
If it's 150,000 and your mortgage is still 200,000,
That's correct.
okay, well then would it be negative? Like you would have a negative equity?
You will be having a negative equity. That is when that is when the housing markets crash, because people end up with negative equity. They foreclose and so on and so on. So $150,000 minus $200,000 will leave you with a negative equity of negative $50,000. Make sense?
Yes.
Mm-hmm. Yeah. Okay. So this is an example of Sunnyvale Clinic's balance sheet. So we have 2 years here, 2020 and 2019. And the current assets are cash, short-term investments, net patient accounts receivable, and inventories. So we have to look at what are the different types of current assets here that can be listed in the balance sheet. The other thing that you need to understand here is what exactly is current assets. So cash and other assets that are expected to be converted into cash within one accounting period, usually 1 year. So if you can change it into 1 year, if you can liquidate it within 1 year, it is a current asset. But if it is a long-term investment, then it is not a current asset. Okay, it is a long-term asset. So let's say you have a MRI machine. It's not like you will buy it today and then sell it to make money, right? You'll use it. You're not going to sell it to make money or something. As a hospital, you will do patient care. You'll provide patient service in order to generate revenue. So the net property and equipment means all of these machines and equipment that you have in your hospital that have a value, right? That have a value, but you're not going to liquidate it within 1 year unless you just are bankrupted or you're closing the hospital and so forth. So these are some components of current assets: cash and cash equivalents, like actual cash; short-term investments that may be, like a treasury note or a treasury bill, which has a life of only 4 weeks or maybe like 2 months, right? And you know already that you will be converting it into liquid, or it will be liquidated and be deposited in your bank account within 60 days. The net patients accounts receivable, usually we get patients payment within 30 days, 60 days. And in fact, let's say you are a patient, you will get notices that your account may go into collection if you don't pay your bill on time. So usually, it doesn't last up to one. They will not let you pay until 1 year. They usually let you pay within 3-4 months. And then inventories, like small inventories, which can be liquidated easily, although you will not do it unless you are facing a hard time financially. But yeah, you can usually do it. But if there is property such as a building or a land that the hospital has acquired, it cannot be called a current asset because it may take more time for it to get liquidated as compared to hard cash. So the total current assets are listed here. And when you add the long-term investments and then the long-term investments, or for example, if you have invested in, let's say, a 401k or a 403b, which is going to, or a retirement account, or like a stock, for example, even a value stock or a growth stock, which runs for a really long period of time, and you usually don't look at it for some time. You try to forget about it. Those things can be long-term investments. And like I already told you, your property, big equipments which are heavy to move and more immobile, can be a part of long-term investments too. long-term assets as well. So your total assets are listed here, $154,000, and for 2019 it was $115,000 for Sunnyvale Clinic. So current assets, like I already told you, they either possess, say, cash, or create, like buildings and equipment. They create economic benefit to the business. So if you have a building, you have an equipment that you're using, then you generate patient revenues because your patients are coming to that building, they're using it, and that creates economic benefit to the business. So these are some types of current assets like cash equivalents, and other assets that are expected to be converted into cash within 1 year, such as securities, like I said earlier, like bills and notes, which last for 4 weeks or 60 days or 90 days at the maximum, and then patients' accounts receivable and inventories. So cash represents actual cash in hand and in your checking account. Cash equivalents are those investments that mature within 3 months or less, and short-term investments are also low risk, very liquid securities. And some examples are treasury bills, like US treasury bills, and they are reported at cost. So if you bought a bill for $100, and that has, let's say, a 4% interest rate on it, and at the end of the 30-day period, you will get $104 for that bill. You will still report $100. Okay, so they are reported at the cost value, because that 4% can fluctuate. We don't know which way the market will go. So you usually report your securities at the cost. So why do businesses hold short-term investments? Any thoughts? What is something about current asset that has an advantage, like that you think is advantageous for hospitals?
You'll see the investment start to pay off sooner rather than later.
Yes, you can liquidate those assets quickly, much more quickly as compared to long-term assets. It may take a long time to sell a building, or if you are a rural hospital, we studied that last week, that value of a land for a hospital may be $20,000, but for an outsider it may be only $10,000, because nobody wants to go live there, and they don't have schools, they don't have like shops and stuff like that. It's a small rural hospital in a rural area serving very few people, but it generates good revenue because it has all of these payments from Medicaid, Medicare. It is a safety net hospital, and so forth. Maybe it solicits some contributions and donations and endowments. Because of all of this, maybe the hospital is doing well, and the value of that land to that hospital is $20,000, but to the outsider is $10,000. So in order to sell this kind of land, let's say the hospital wants to get rid of it, right? And they want to sell it. If the value of that land to the outsider is $10,000, do you think they'll go and buy it?
No.
No. And do you think the hospital will be able to liquidate it quickly, like current assets?
No.
No. So, and that is why those are called long-term assets. So businesses should hold short-term investments for the very advantage that current assets or short-term investments provide. And that advantage is that they can be converted into cash quickly. And I have told you several times that cash is a lubricant for the wheels on which a company or a hospital runs. All right. So current assets. There are costs to carving current assets to healthcare organizations, and they have to balance the need for liquidity against the associated costs of maintaining liquidity. Meaning that if you invest in highly liquid, low risk investments, you will make less cash when you sell them. Because current assets are expected to be quickly converted to cash, they are important for the liquidity, like I told you. And now there is a good measure of liquidity, and that's called the net working capital. Net working capital, and again, focus on the name itself. Net working capital is a capital that you can work with, right? It is liquid, it is there for you, and you can work with it. So net working capital is a difference of your assets minus liabilities. So in the case of Sunnyvale Clinic is $54,000 approximately minus $15,000 leaves you with approximately $39,000. So this means if there is greater liquidity, greater net working capital, and that is better. Oh, hold on. So cash represents actual cash plus the money in banks, and short-term investments represent temporarily invested in low-risk, highly liquid securities, such as money market mutual funds. And all of this represent liquidity, and so does the net working capital. Now, when net working capital is high, that means your liquidity is high, and that is a good thing. So basically, this means that your obligations are much less as compared to the amount that you have or you possess. So if this number is lesser and lesser, the net working capital will be higher and higher, right? And that means that you have more liquidity. You're not obligated to pay to your vendors, your suppliers, and other people on your loans and mortgages as much as what you have. You have almost met your obligations of payments. All right. The net patient's accounts receivable is the money that is not collected, that are revenues that are owed to the business, but they still have to be received because you have provided that service and you have not been able to get the money for that. So patient service revenue was reported at approximately $170 million for in the income statement that we did last week, and there is a receivable of approximately $28 million as receivables. So where is this money that has been collected? So let's say the $169 million that was reported in patient service revenue in 2020 on the income statement. And then there is some receivables that are yet to be collected. So there is the difference. This is the difference, $141 million that has been collected. Where do you think it is reported? So the $169 million that was reported in patient service revenue, all of this was not collected. Okay, all of this was not collected. $28 million are still outstanding. They still have to be received. So the $141 million have been collected. Do you think they are a part of the operating income? Yes, they are a part of the operating income because they have been collected, and that is the income that you have generated. Okay. All right. So we move on to inventories. Inventories represent the dollar amount of expendable supplies on hand. For providers, inventories are usually medical supplies. You don't want to have too many inventories because there is storage issues. And they may expire, especially if it is medical supplies and medical inventories. They may expire more quickly as compared to other types of inventories like furniture and stuff. So only supplies that are actually consumed in treating patients are expensed on the income statement. So if you buy a pack of, let's say, 100 gloves, right, 100 medical gloves, and you have used only 10 of them, so you will be reporting the cost associated with only those 10 gloves. You will not report or expense on the income statement all of those 100 gloves, even if you have bought it and even if you are storing it. Okay? So providers with small inventory balances, usually they have a catch-all phrase, and it's called other current assets account. Any questions on inventories?
Dr. Yusuf, did you say for the inventory you only report the one that you used?
That you use.
Okay,
Yes.
thank you.
Yeah. If you have, let's say, 1,000 injections and you have used only 100 of them, so you report only those 100 injections on your income statement. Report as a new expense, only those. Remember, the components of income statement are revenues and expenses. So when you expense it, you will include only those 10 or 100 injections, because those are the only ones that have been used towards patient service. Good question. All right. Current assets. Current assets are listed in order of liquidity or nearness to cash. So remember, we have all of these types of current assets, which we saw a couple of slides ago. But do you list them randomly? Like, would you list them inventories first and then cash here? No. You would list them in the order of liquidity. So which one is the most or the easiest to be converted into cash? So if it is cash, let's say it's actual dollar bill, that is actually cash. So we don't need to, that is the most liquid. So we'll put it on the top. The second one is short-term investments. Short-term investments, meaning I told you the notes and the bills, now which they can be converted into cash quickly at 30 days or so. That will be the second one. Net patient accounts receivable might take a little bit longer to receive and be converted into cash, so we place it third. And inventories, as you can imagine, and I've told you before, if you have bought a pack of 100 gloves and you have used 10 of them, you're not going to sell 90 gloves, right, to make money. That is not so easy. Nobody's going to buy those 90 gloves, but hypothetically you may do it, and that's why you put inventories the last. So it is very close to a long-term asset, inventory, I'll say. And especially if those are big inventories and like equipments such as MRI machines, CT scans, and so forth, those are even difficult to sell because of their immobility. Current assets are necessary to support operations, but they provide no monetary return, right? We will not get much interest unless we are, already that if you have money in the bank account, you get like 0.1% interest rate or maybe 0.001% interest rate. But if you put it in 401k, or if you put it in a student account, or some fixed deposit or something, you get a higher interest rate. The reason is, if you have current assets, you usually get no monetary return because you don't get the interest on it. So the question for you to think about is, should businesses hold large amounts of current assets?
No.
Yeah. You cannot hold, just as personal finance, you should not hold large amount of money in your bank. Same way for the hospitals, don't hold large amount of current assets in your bank. If you have enough that can help you survive for 6 months to 1 year, which is also the definition of current assets, 1 year. So you find out how much you need to survive for 1 year. You put that money as a liquid account, And the remaining you can put in a long-term asset where you can get more monetary return because you've invested it and they are giving you better interest rate and the money is growing. Okay. And so now it brings us to long-term investment because we just said that hospitals or businesses should not hold large chunks of money in current assets. If you have large chunks of money in current assets, it's better to invest it in long-term investments. So long-term investments are in stocks and bonds. It can be these are investments in securities, financial assets, as opposed to buildings and equipments like real assets that have maturities greater than 1 year. Sometimes this account is referred to as funded depreciation. I think okay. The other thing I wanted to mention about current assets just came to my mind was think about inventories, right? Let's say your inventory is your current asset because it is here. You have inventories as current assets. So maintain only that much supply that is enough that to act as a safety stock guard against unexpected surges. So if you think about COVID, right? Think about COVID, and there was a surge in the need of inventories. We just needed the protective equipment like anything. It was all over the place, and people were running out of protective equipments. People were running out of medicines and so forth. If there is an unexpected surge in demand, you need that much, but you should not hold too much. So we did talk about the money part a little while ago, but now we are also thinking about the inventories. If inventories are current assets, should you stock up too much? So don't stock up too much of inventories either. Sorry. So going back to long-term investment. So this account is also referred to as funded depreciation, and they have maturities that are greater than 1 year. So if it is current asset, it is less than 1 year. If it is a long-term investment, it has maturity that is greater than 1 year. And they are reported on the balance sheet at fair market value. And these long-term investments can be used to purchase new land, new buildings, and new equipments. So long-term investments are used more by not-for-profit businesses than by investor-owned businesses. Why is that?
Is it because the money that nonprofit businesses make go directly back into the business?
Yes, good answer. And what happens in the case of investor-owned businesses? Keep going.
They have fees to pay, so it doesn't get a chance to go back into the business.
They have what to pay?
Huh?
What do they have to pay?
Some taxes and other fees that have to go back, that don't get a chance to go back into the business.
Yes, they have to pay taxes, but they also have to pay some very important people. Who are those people?
The investors.
Investors, yeah, and stockholders.
Voters, yeah.
Yes. So for not-for-profit businesses, the long-term investments work as savings account that can be used to purchase new land, new building, and new equipment. But for investor-owned companies or investor-owned hospitals, any cash flow that is in the excess of the amount is reinvested, and even before it is reinvested, it has to be paid to the stockholders. So that is the reason it is used more by not-for-profit businesses. All right, good answer. So moving on, the next one is property and equipment. Net property and equipment represents real assets as opposed to financial assets. So just let me go back to this slide 1 second here. So we covered current assets, all types of current assets. This is total current assets. We also talked about long-term investments. This is long-term investments, but not real assets. Now we are talking about net property and equipment, which are real assets. So we go back here. Here. So this represents real assets that have lives greater than 1 year, and usually those are fixed assets. So when we say fixed, what we mean, they are highly illiquid, they will be used over long periods of time, and there is depreciation that is incorporated in it. Means there is going to be wear and tear. Once you start using a house or a car or an equipment, you will have wear and tear. So depreciation is definitely going to be a part of it. So in general, the assets that are reported on this line, they consist of land, building, and equipment, like I just told you. And only a net amount is reported on the face of the balance sheet. And if you have the note section that goes with your balance sheet, then you can break it down over a period of years and report it that way. So when they are purchased, fixed assets are posted on the balance sheet at their original cost. So if you bought a building for $100,000, you will report it at $100,000. Then each year, the accumulated depreciation account is increased by the amount of depreciation that is reported on the income statement. So the net property and equipment amount is reduced each year by the depreciation expense. So let's say within property and equipment line, you have a land and you have some buildings and equipment. So your total for property and equipment is $88,000. And then you remove the depreciation cost from it. So you have an annual depreciation. In this 2-3 sentences, they have said that you have a depreciation that is reduced each year. We have an annual depreciation expense. So you have an accumulated depreciation of $36,000 over a period of, so until 2019, your accumulated depreciation was $29,000. Now in 2020, it is $36,000. So you have to subtract this number from the property and equipment total to get the net property and equipment. Okay.
Dr. Yu, I have a questions
Yes.
about that. Where did they get that amount? Is there like a certain percentage to be equivalent to that amount for the depreciation expense?
No, it doesn't say any percentage so far. So there might be, at least in this chapter, they are not telling us how to calculate the depreciation,
Yeah.
and it might differ from organization to organization. But they have given us a lump sum of accumulated depreciation as $36,000 for 2020. And we minus that from the total property and equipment,
Got it.
gross property and equipment, to get a net property and equipment.
Okay.
Yeah,
Thank
no,
you.
we are not talking about a percentage here, at least for the scope of this class.
Okay.
And the other thought that comes to mind is sometimes the wear and tear also depends on the usage. So if you have a car that you have driven, like 100,000 miles in 2019, and then COVID happened, you were home and you did not drive it as much in 2020, the depreciation will not be as much in 2020 as compared to what it was in 2019. All right. Any other question before we move?
No, I'm good. Thank you.
Okay. All right. So Sunnyvale Clinic liabilities and equity are shown here. Okay. So we have current liabilities, total current liabilities. In current liabilities, we have notes payable, accounts payable, accrued expenses, and then we have long-term debt. And then we add these two to get the total liabilities. Then we have the equity. And then we also add these two to get the total liabilities and equity. So we'll talk about those. So liabilities represent claims that are against assets that are fixed by contract. Okay. You have a contract for a loan, and it is against a house. You bought the house and you got a loan for, let's say, $50,000 for the 100,000 house. The bank that is giving you the loan of $50,000 knows that when you sell the house, you probably will make more than $100,000. So they know that it is against a asset and you have a contract with them. So liabilities are fixed financial obligations of the business. And let's say you have a 30-year loan, so you have to pay it over a period of 30 years. So you are obligated to pay that mortgage amount over a period of 30 years. And if you don't meet these claims and obligations, then you can be foreclosed, you can be bankrupt, and so forth. And all of this is the same in case of hospitals. They also buy lands, they also buy buildings, and it works the same way for them. Although some liability obligations are to suppliers, employees, tax authorities, and vendors, the largest obligations are to creditors, which is banks in this case. So whoever you're getting the loan from, that is the largest obligation. You can pay your employees, you can pay your suppliers, you can pay your vendors, you can pay your tax people, but you also have to pay your creditors or the loans that you have bought, that you have obtained. So current obligations are those that must be paid within 1 year, one accounting period. And some of the common liabilities are accounts payable that you have to pay within 30 days or 60 days to your suppliers or vendors, any expenses that you may have, and notes that you have to pay. Notes payable are short-term debt obligations. Typically, they are bank loans and they have maturities of less than 1 year and often takes the form of a line of credit. And it is used to finance temporary increases in current assets. An example of notes payable is, let's say there is a walk-in clinic and it builds up its inventories or medical supplies, but when the season is over, the supplies is back to a lower level. This temporary increase is funded by a bank loan of some type. So if they want more supplies of something, then they'll take a short-term loan, and that's called notes payable, and they will fill up those supplies. And when they're not in season, let's say the flu season is not there, they don't need that much of that medicine or that injection, they will not take that loan. They will not, and that is a short-term loan, so they will not take it loan. So usually such seasonal increases or decreases in demands of medical supplies is funded by a bank loan of some type. Accounts payable stems from buying goods from vendors on credit called trade credit. Remember we talked about this earlier. So if you have to pay your vendors, the vendors can say that pay us within 30 days, and that's called net 30. It's termed as net 30, and it is carried in the accounts payable section. So they may also say that if you pay it within 30 days, we'll give you a 10% discount, or if you pay it in 60 days, we'll give you a 5% discount on your payment. So those are the payment terms that vendors usually set. So how much trade credit should be used? So trade credit is what you are basically getting some supplies from your vendors on credit. So let's say a vendor came to your hospital and they said that we are delivering 1,000 gloves to you and you don't have to pay it today. You can pay it within 30 days. So how much trade credit of that kind should be used by hospitals and why? Think about cash and liquidity. Would you rather pay within 30 days or would you rather, in gloves is a simple example, but let's say it's more different kinds of supplies. Would you rather pay within right away?
I think it depends because the faster you pay, the less time you can use that money for other investments.
Yes,
So you want a good balance of both.
that's very correct. The other thing you keep in mind is that if the vendor is giving you a discount for paying within 30 days, well, they probably will give you more discount if you pay them right away. But if you want to pay within 60 days, let's say, and they're saying that we are going to give you a discount if you pay within 30 days, then let's use that discount because by using that discount, you are building up cash. Okay. So that's about trade credit. It is something similar to, paying off your debt on your credit cards easy, not having too many credit lines, or not having too many credit card debts and so forth, like auto loan and credit cards and so many things, people have. So yeah, similar thing. Now, long-term debt represents debt financing with maturities that are greater than 1 year. Smaller businesses often obtain long-term credit from commercial banks. Such debt is called a term loan. Large businesses sell bonds. So if it's a maturity that has more than 1 year, it's called a term loan. And if you want to provide more notes on the financials, more information about the long-term debt, you can go to the notes section of the financial statement and you can write it there. And the next one is equity. We talked about equity. Net assets present the dollar value of assets that remains after subtracting business liabilities. So equity represents the non-liability claims that are against a business's assets. Now, if your house has increased to from $100,000 to $200,000, and you have an obligation to pay $50,000 loan, and $200,000 minus $50,000 leaves you at $150,000, right? That's equity. You don't have to pay it to anyone, right? And that is why it's called a non-liability claim. You don't have the liability of paying that $150,000 to anyone. You can keep it, and that is the equity. They are not fixed by contract. Nobody tells you, oh, we are going to pay you $150,000 over a period of 10 years. So there is no contract there. For investor-owned businesses, equity is the amount of owner-supplied financing. So what the money that is generated by the business or the hospital itself, that when it is an investor-owned hospital and they're financing themselves, that is the equity. For not-for-profit businesses, equity is the amount of capital that is supplied by the community. That is coming from, contributions or the charity work that they provide and so forth. So as mentioned earlier, the equity account is a residual. So equity is the difference of assets and liabilities. When you minus your liabilities from your assets, that is your equity. Any questions so far?
No.
What is an equity?
It's your net assets.
Mm-hmm.
So the total assets minus the total liabilities.
Mm-hmm. Mm-hmm. Yep. What else? What are some components of the liabilities and equity side of the balance sheet? We have current liabilities. And what are current liabilities? How long do you have to pay that? Yeah, go ahead.
I was about to say current liabilities usually have to be paid within 1 year, and they include notes payable, accounts payable, and accrued expense.
Very good. And then what other things are included in the liabilities and equity section of the balance sheet? Do we see long-term debt here? We just talked about long-term debt. We also talked about equity, right? So when you add your total liabilities and your total equity, that gives you total liabilities and equity. Okay? So that is what the liabilities and equity side looks like. Sorry, how did that happen? I want to do a couple more slides and then we will break. And then we'll, do the rest next week. All right. I think I moved. Yeah, this one. So the equity section of the balance sheet, more than anything else, distinguishes an investor-owned business from a not-for-profit business. So whenever you have to distinguish an investor-owned business from a not-for-profit business, think about two things. One is tax, and you said that earlier, and the other one you said was stockholders. So they are liable to their stockholders, they have to pay out the dividends to their stockholders, and they have to pay tax. Those are the two key differences between an investor-owned business and a not-for-profit business. So in a not-for-profit corporation, the equity account is called net assets. It is the dollar value of assets, which is the net of liabilities. Okay, that is the not-for-profit, and it is always called the net assets for a not-for-profit. Now, a for-profit section, for a for-profit equity section may look like this. Stockholders' equity represent that the stockholders on the business. So 9,000 was collected by selling common stock to stockholders. So this investor-owned hospital, they sold $9,000 of common stock to their investors, and that's how they generated the equity. Retained earnings represent the accumulation of earnings over time that are reinvested in their business. Retained earnings are not readily available to buy new equipment or to pay dividends or for any other purpose. And then total equity is a sum of these two. Okay? So what is the difference between the equity section for a not-for-profit hospital and a for-profit hospital?
It's the tax that they paid and the stockholder.
Yeah. Whatever you have, the money that you have generated, it's not what you have paid. This is the money that you have sold worth of stock. So many people bought a total of $9,000 worth of stock for this hospital, whichever hospital this is. And that is the equity that is coming from common stock. And that is why it's called stockholders' equity. The other thing in stockholders' equity is retained earnings, and they are accumulation of earnings that are reinvested in the business. So that is another section. And those two together form the total equity section for the for-profit. And the not-for-profit is very simple. You don't have all of this, and that makes a not-for-profit. That is very simply, it can be put like that. So there is a couple of differences that we'll go over here. Note that the retained earnings account, the entire net equity account for not-for-profit organizations, is affected by the amount of net income that are shown on the income statement, right? Whatever net income you have generated on the income statement, that has to flow in the balance sheet. So for a not-for-profit business, the entire amount flows into the equity section of the balance sheet. You don't have to pay taxes. You don't have to pay your stockholders. However, for a for-profit business, some of the net income has to be paid out as dividends, and then the remainder flows to the balance sheet. And this relationship is detailed in the statement of changes in equity, which is not a part of this. It was a part of the last chapter. We did talk about statement of changes in equity. So these are the two differences. And we have gone over these differences even in the last week when we are discussing the income statement. And many of you might remember it as well. Yeah, okay. One more slide and finish. The right side of the balance sheet gives the business's mix of debt and equity financing, which is called its capital structure. Remember, there is a left side and there is a right side. When we talk about the right side, we are talking about the liabilities and the equity. And when we combine them together, that is the capital structure. Capital structure is a key financing decision because it affects the overall risk of a business, and the cost of financing. How much will be the cost of financing? So Sunnyvale's balance sheet reported about $54 million in equity for 2020. One of the physicians proposed that the equity should be used to build a new clinic on the north side of town. Is that 54 million available for this purpose?
No.
No. And why do you think so?
I think that first and foremost, it would be irresponsible to use all of one's equity on one investment, because then you can't invest the money into anything besides the clinic.
Yes, but just think about the money aspect of it, and think about whether this money is current asset or is it a long-term asset? Meaning, so equity is basically the difference of liabilities and assets. So if you have an equity of $54 million for 2020, do you think it is available in cash, or do you think it might be in buildings or other places which can not be converted into liquid money so easily? It
Right.
may
So
be
you're
in long-term investment accounts. Only the portion that is sitting in cash is available to the business for use. Or this money may have been used to fund something else already, which the physician does not know about. So we don't know if this money is available for this purpose or not. Because remember that equity is a retained earning. It is a claim against asset, and it may not necessarily be readily available, right? If the value of our house is $200,000, it doesn't mean that I have $200,000. I am going to have the $200,000 only when I sell that house. If I'm living in that house, if I'm using it, that $200,000 is only on paper. It means nothing to me. So it was reported. It is not saying that they have $54 million in equity. It was reported, but we don't know if it is readily available. And even if, let's say, they sell the building and they can use it, we don't know if it is easy enough to sell that building, or if that money can be used in other long-term investment accounts, or there can be something else that it can be used for. So we don't know if it is available for this purpose or not. Make sense?
Yeah,
Yes.
that makes much more sense.
Yeah. All right. So with this, we are going to finish today.